Hello guys, this is your boy Motoba from Motoba Insurance College. With me, we're going to be studying a book entitled ITC Insurance Training College, a book that helps to enhance professionalism. It's usually given to Ugandan secondary students. They usually have annual contests about the book. We're going to be studying the second edition of this book. It's so good. Anyone who learns about this book will have prior knowledge to insurance and how it works. Without waste of time, let's look at the table of content of this book. The book contains 3 sections. Section 1 talks about the fundamentals of insurance, in which Chapter 1 talks about introduction to insurance. Chapter 2 talks about risk and insurance. Chapter 3 talks about principles of insurance. Chapter 4 talks about the insurance market. Chapter 5 talks about regulation of insurance industry in Uganda. Section 2 talks about principles and practice of general insurance business, in which Chapter 1 talks about introduction, Chapter 2 talks about insurance documentation, Chapter 3 talks about underwriting and reinsurance process, Chapter 4 talks about property insurance, Chapter 5 talks about transport insurance, Chapter 6 talks about liability insurance, Chapter 7 talks about claims management, Chapter 8 talks about emerging issues. Section 3, the last one, talks about principles and practice of life and pensions business, in which Chapter 1 talks about introduction to life assurance, Chapter 2 talks about generic classes of life assurance, Chapter 3 talks about pensions and retirement planning, Chapter 4 talks about life assurance documentation, Chapter 5 talks about claims processing. Yes. Let's kick up with the first section that talks about the fundamentals of insurance. Let's begin with introduction to insurance. So, without waste of time, the introduction to insurance. In Uganda, insurance services form part of a larger financial market with several financial products to suit the needs and demands of the stakeholders. In this chapter, we shall define the key terms used in insurance, explain the historical development of insurance in Uganda and East Africa, and clarify its importance to individuals, business entities, and the economy at large. Furthermore, the chapter will explain the functions of insurance or the functioning of insurance. Let's talk about the key terms. Insurance. This is the equitable transfer of the risk of a loss from one entity to another in exchange for payment. It is a form of risk management primarily used to caution against the risk of a contingent or uncertain loss. An insurer or insurance carrier. This is a company selling the insurance. The insured or policyholder is the person or entity buying the insurance policy. The price charged for a certain amount of insurance coverage is called the premium. The transaction involves the insured assuming a guaranteed and non-relatively small loss in the form of payments to the insurer in exchange for the insurer's promise to compensate or indemnify the insured in the case of a financial loss. The insured receives the contract called the insurance policy, which details the conditions and circumstances under which the insured will be financially compensated. The basic assumptions is that insurance operates on the principle of spreading risks, sharing risks, or creating a financial pool from which unfortunate members are compensated. Second key term, risk. This can be defined as the uncertainty of a financial loss. In broader terms, risk can also be described as the object of insurance. Peril. This can be defined as a cause of a loss, for example, fire. Hazard. A condition that may increase or decrease the chance of loss. For instance, poorly stored fuel creates condition for fire. Loss. Unintentional decline in or disappearance of value arising from a contingency. Please note that the use of the term assurance with letter A, assurance in life insurance signifies a deliberate provision of financial protection, distinguishing it from situations of unintentional loss. Claim: a form of request to an insurance company by the insured party asking for payment based on the terms and conditions of the insurance policy when the insured risk occurs. Premium: an amount of money charged by the insurer in exchange for the insurance service. Policy: a legal document that contains the terms and conditions of an insurance contract between the insurer and the insured. It is issued as evidence of the existence of the insurance contract or cover for the insured risk. Assurance: this is the term that is used in life insurance to reflect the fact that the peril insured against will take place sooner or later. The events are not necessarily fortuitous. For instance, death will definitely occur. However, the cover is not taken against the event of death, but rather against the uncertain timing of death. While the cover is generally taken against the event of death, some policies only occur the uncertain timing of death. A whole life cover is taken to cover the event of death. Assignment: this means the transfer of ownership and rights enshrined in an insurance policy from one person to another. This normally applies to life assurance. Material facts: these are facts which would influence the judgment of a prudent underwriter in deciding whether or not to accept the risk. Let's talk about the history of insurance. In this section, we will look at how traditional insurance evolved into today's modern insurance, with the fundamentals of creating a pool of homologous risks being maintained through this evolution. Also, we shall look at how modern insurance was introduced in Uganda. Overview of the history of insurance. The history of insurance in the world cannot be traced to a single school of thought. However, in principle, these various schools of thought tend to point towards creating a pool of funds to pay for the losses of the unlucky few. History has it that marine insurance is the oldest form of insurance. Let's talk about the history of modern insurance. In some sense, we can say that insurance dates back to early human society. We know of two types of economies in human societies: natural or non-monetary economies, using barter and trade with no centralized nor standardized set of financial instruments. And the second type of economy, that is the monetary economy, which contains markets and currency, financial instruments, and other financial infrastructures. Insurance in the former case entails agreement of mutual aid. If, for example, one family's house gets destroyed, neighbors are committed to helping rebuild it. Insurance became more sophisticated in the Enlightenment era in Europe during the Industrial Revolution, and specialized varieties developed. Some forms of insurance developed in London in the early decades of the 17th century. For example, let's look at this. Marine insurance, whose origin can be traced to maritime trade as early as 3000 BC. Here, merchants suffered losses basically involving the robbery of the goods and ransoms. And as a way of reducing these risks, they agreed to create a pool of funds which they would draw funds to pay for the losses. In addition, traders opted to spread their goods into or more ships, so that in the event of one of the ships being robbed, they would not lose everything. Lloyd's of London, which is the largest marine insurance market in the world today, was among the earliest providers of modern marine insurance. Let's talk about the fire insurance. The Great Fire of London of 1666 is largely marked as the beginning of the fire insurance. This fire wiped out the entire town structure, which by then was wooden. And as a result of this, several companies came up with fire insurance as a positive response to what had happened and by way of providing a risk management solution against fire incidents. Did you also know that the Finance Act of 1970 required insurance companies not locally incorporated to allow 49 out of 51% government and private ownership participation? Yeah, let's talk about the development of modern or current insurance in Uganda. Modern insurance was introduced to the country during the colonial era. The first locally owned insurance companies include the East African General Insurance Company, that is the EGIN, was incorporated in 1946, followed by National Insurance Corporation, that is the NIC, in 1964. Prior to that, only agencies and branch offices of foreign insurance companies, mainly from the UK, India, and America, which numbered about 95, were in operation by independence in 1962. The Financial Act of 1970 required insurance companies not locally incorporated to allow 49 out of 51% government and private ownership participation. From these, Uganda America Insurance Company Limited, Jubilee Insurance Company, British American Company Limited, and United Assurance. All of those were locally incorporated and wholly owned by Ugandans in 1972. Were formed. Yeah. Then you should also know that from the midst of 1970s to the midst of 1980s, insurance experiences setbacks, namely the economic war, internal armed conflicts, and the May 1987 currency reform, among others. You should also know that there were 31 licensed insurance companies, in which 21 were non-life farms and 9 were life farms. Secondly, 32 insurance brokers. Fourth, 2 health membership organizations. 5, 3 pre-insurance brokers. 6, 22 loss assessors. 7 adjusters. And over 3,200 agents as of 2022. The Insurance Regulation Authority, the IRA, which was established in the 1996 to ensure the effective administration, supervision, regulation, and control of the insurance business in Uganda, has raised confidence in the industry. To further boost this confidence, a number of insurance and brokerage companies have invested heavily in public awareness. IRA and the Uganda Insurers Association have also embarked on an extensive awareness campaign. Let's talk about the major legislations that have influenced the development of the Uganda insurance industry. 1. Motor vehicle insurance third-party risks first came to the scene in Traffic and Road Safety Act 1970. 2. The Motor Vehicle Insurance Third-Party Risk Statute was enacted in 1988. 3. The Yellow Card Scheme, the Protocol on the Establishment of the Third-Party Motor Vehicle Insurance System by PTA member states. 4. The Workers' Compensation Act 2000. 5. The Marine Insurance Act 2002. 6. The Insurance Players Professional Association, UIA. as per section 94 of 1 of the statute. The Insurance Institute of Uganda 1964, the Uganda Association of Insurance Brokers 1971, the Uganda Association of Engineering Valuers and Loss Assessors 7 point. The Insurance Regulation Authority of Uganda (IRA) was established under Section 14 of the Insurance Statute 1996, now the Insurance Act, Chapter 213, Laws of Uganda 2000 Insurance Act, which came into effect on 4th April 1996 and commenced operation in April 1997. The second last point, the Insurance Act 6, 2017. Lastly, the Insurance or Bancassurance Regulation of 2017. Let's talk about the functions of insurance. This refers to the mechanism of how insurance operates to manage the risks. The risks are transferred to the insurer by values or by various individuals or organizations that are willing to pay premiums. The insurer is responsible for creating a financial pool from which the few who suffer losses are compensated. There are three main functions of insurance, and these are: 1. Risk transfer. It is a mechanism by which the financial consequences of an event are shifted from one party to another. Take an example of a property owned or landlord asking a tenant to sign a tenancy agreement that holds the tenant responsible for any losses arising from the building catching fire. Second point, creating of a common pool of funds. Insurance operates on the premise of large numbers, where the insurer takes contributions in the form of premiums from individuals, corporate companies, government agencies or departments, and non-government organizations, business entities exposed to similar or homologous or homogeneous risks, and creates a common pool of funds from which the insurer pays the few who suffer losses. As in the example above, the insurance company would create a pool of residential house owners since they are exposed to similar or homogeneous risks like theft and the escape of water from its normal confines, like tap and sink. The third point, equitable premium. A fair premium collected from members of the common pool that reflects the risk exposure that each of their risks bring to the pool. For instance, a person proposing to insure a grass-thatched house would be charged a higher premium than a person proposing to insure an iron-roofed house. Equitable premium should be taken or should take into consideration the risk profile, frequency and severity of the risk being charged or being passed onto the pool. Each of the house owners in the example above would be charged premiums depending on a number of factors that include the location of the house, security system installed, and the nature of the contents inside the house, among others. Therefore, a house in upmarket Kololo and Naguru Hills will be charged fairly lower on the factor of high security as compared to a house in the neighborhood of Wise, where the likelihood of theft or burglary is close to 100% within a 1-year period. In short, the premium charged by the insurance company is commensurate to the risk being ceded into the insurance pool. You can give example of the pool of private cars. Yeah, you understand that. let's talk about, and also the owners of these cars will pay a premium to an insurance company to cover the risk of accidental damage or theft of cars and third-party liability risks. However, each car is unique in terms of the model, year of manufacture, accessories, and because of such differences, they present different levels of risk exposure to the pool created by the insurance company, and hence each will be charged a premium equal to the risk associated with its uniqueness, that is equitable premium. The last part talked about the importance of insurance. The major role of insurance is to provide peace of mind to the insured, who could be an individual, business entity, and society as a whole. The role and importance of insurance in this book has been discussed in 3 broad categories. 1, individual. 2, business or company. 3, society or economy. Let's start with the importance of insurance to an individual. 1, insurance provides security and safety. Insurance affords peace of mind. Insurance protects mortgaged property. Insurance eliminates dependency. Life assurance encourages savings or profitable investment. The importance of insurance to a business or company. Uncertainty of business losses is reduced. Business efficiency is increased since insurance compensation provides the necessary funds for business continuity. Key non-indemnification. Enhancement of credit since the insurance policy can act as collateral for the loan. Lastly, importance of insurance to the economy. The wealth of society is protected. For example, the loss or damage of property by fire and accident can be well indemnified by property insurance. Economic growth of a country, for instance, the pooled funds are deposited with commercial banks which borrowers can access to invest in the economy. Provides international trade. Lastly, for job creation for insurance professionals. So that is it. Chapter is so beautiful. In summary, the key ideas covered in this chapter are summarized below. Insurance is a way or mechanism of transferring the insurance risk to an insurance company for a price called premium, such that in the event of a loss, the insurance company will compensate the policyholder or individual or company as per the terms set out in the insurance contract. And also, insurance works by creating a pool of homogeneous risks from which the premiums of a pool of risks from different policyholders pay for the losses of the unlucky few. And as well, in the pool, each policyholder is charged a price that is commensurate to the level of risk that their property, for example, a car, brings to the pool. Lastly, insurance as an industry is important for individuals, society, and the whole nation, as it creates jobs by enabling the smooth running of the business. So that is chapter 1. Thank you for being with me. Let's move to chapter 2.